Today, we're going to focus on the topic of leasing from an accounting perspective. Let's get started. Leasing can be understood as a contractually regulated transfer of the right to use an asset, with the option of either returning the asset or purchasing it at a residual value. This means that the lessee is given the use of an asset, for example a vehicle or a production machine, by the lessor for a specified period, and at the end of the lease term, the lessee either returns the asset to the lessor or pays the residual value to retain the asset. From an accounting perspective, leasing is categorized into two different forms: operating leasing and finance leasing. In operating leasing, the leased asset remains on the lessor's balance sheet, and the lessee simply pays a monthly fee known as the lease payment, which is recorded as an expense. The balance sheet of the lessee does not change, as the leased asset, such as the production machine, does not appear on the lessee's balance sheet. In finance leasing, however, the leased asset appears on the lessee's balance sheet. In this case, the production machine, for example, is added to the lessee's fixed assets, and in addition to the lease payment, depreciation of the machine is also recorded since it is now included in the lessee's balance sheet. For companies, it has direct consequences whether a leased asset is classified as operating leasing or finance leasing. Great, so now we know the two forms of leasing we're dealing with. The only question left is about the advantages and disadvantages of leasing from a business perspective. Let's start with the advantages. One major advantage of leasing is that it helps avoid technological obsolescence. Returning to our example of the production machine, the lessee can simply return it at the end of the lease term and replace it with a newer, more modern machine. This way, the lessee always stays up to date with the latest technology. Another advantage is that leasing increases planning security. Since the lease payment and the lease term are contractually fixed, the company is well positioned to estimate the monthly financial burden and plan accordingly. Finally, leasing offers the advantage of maintaining the company's liquidity, meaning its ability to pay. With leasing, the lessee does not have to pay for the leased asset in full upfront, but only covers the lease payment and potentially the depreciation costs, which reduces the company's monthly financial burden. However, alongside these advantages, leasing also has some disadvantages that we need to consider. Typically, since the leased asset is usually returned at the end of the lease term, no ownership of the asset is acquired. This means that the company cannot, for example, sell the production machine. Additionally, the lease contract is usually not terminable early, which is another disadvantage. The company must adhere to the agreed lease term, even if, for instance, the production machine is no longer needed. Finally, leasing is relatively expensive when all the lease payments are added up over the lease term. Thus, an outright purchase is usually much cheaper than the total sum of the lease payments. Companies should always be aware of the advantages and disadvantages before signing a lease contract. We hope this video has helped you understand the topic of leasing. See you next time and have a good one.